Unit 12. Real Estate Financing. Adjustable Rate Mortgage, ARM, a type of mortgage loan in which the interest rate may periodically adjust up or down based on market conditions, typically after an initial fixed rate period. Adjustment period, the period between rate adjustments on an adjustable rate mortgage. Affordability Index, a measure used to determine whether a borrower can afford to purchase a home, based on their income and expenses. Annual Percentage Rate, APR, a standardized measure of the cost of borrowing money, expressed as a percentage rate. Backhand Ratio, a debt-to-income ratio that compares a borrower's total debt to their total income, including their proposed mortgage payment. Blanket Trust Deed, a single mortgage or deed of trust that covers multiple properties. California Housing Finance Agency, CalHFA, Loans, a government agency that provides financing and programs for affordable housing in California. CalVet Loans, a state-sponsored program that provides financing for California veterans to purchase homes. Closing the loan, the final step in the mortgage process, in which the borrower signs the loan documents and the lender disburses the loan funds. Commercial banks, financial institutions that accept deposits and make loans to individuals and businesses. Computerized Loan Origination, CLO, the use of technology to automate and streamline the mortgage loan origination process. Conforming loans, mortgage loans that meet the standards set by Fannie Mae and Freddie Mac, including maximum loan amounts and borrower qualifications. Construction loan, a short-term loan used to finance the construction of a new home or building. Controlled Business Arrangement, CBA, a business arrangement between a real estate brokerage and a mortgage lender, in which the brokerage has an ownership interest in the lender. Conventional loans, mortgage loans that are not backed by a government agency, such as Fannie Mae, Freddie Mac, or the FHA. Convertible ARM, an adjustable rate mortgage that can be converted to a fixed rate mortgage at a later date. Cosigner, a person who agrees to assume responsibility for a borrower's debt if the borrower defaults on the loan. Credit union, a financial institution that is owned by its members and provides banking services, including mortgage loans. Direct endorsement, a program offered by the FHA that allows approved lenders to underwrite and close FHA-insured loans without prior review by the agency. Discount points, fees paid by the borrower at closing to lower the interest rate on a mortgage loan. Discount rate, the interest rate at which banks can borrow money from the Federal Reserve. Dodd-Frank, the Dodd-Frank Wall Street Reform and Consumer Protection Act, a federal law passed in response to the financial crisis of 2008. Due on sale clause, a provision in a mortgage or deed of trust that allows the lender to demand full repayment of the loan if the property is sold or transferred. Equal Credit Opportunity Act, ECA, a federal law that prohibits lenders from discriminating against borrowers on the basis of race, color, religion, national origin, sex, marital status, age, or receipt of public assistance. Fair Credit Reporting Act, FCRA, a federal law that regulates the collection, use, and dissemination of consumer credit information. Fannie Mae, the Federal National Mortgage Association, a government-sponsored enterprise that purchases and guarantees mortgage loans. Farmer Mac, the Federal Agricultural Mortgage Corporation, a government-sponsored enterprise that provides financing for agriculture and rural development. Federal Reserve, the Central Bank of the United States, responsible for regulating monetary policy and overseeing the banking system. FHA-insured loan, a mortgage loan that is insured by the Federal Housing Administration, a government agency that provides mortgage insurance to protect lenders against losses due to borrower default. Fixed-rate loan, a mortgage loan with a fixed interest rate and a fixed term, usually 15 or 30 years, which means the borrower makes equal monthly payments until the loan is fully repaid. Freddie Mac, Federal Home Loan Mortgage Corporation, a government-sponsored enterprise that purchases and guarantees mortgage loans originated by lenders, thus providing liquidity to the housing market. Front-end ratio, a debt-to-income ratio that measures a borrower's ability to meet housing expenses, such as mortgage payments, property taxes, and insurance. The front-end ratio is calculated by dividing the monthly housing expenses by the borrower's gross monthly income. Ginnie Mae, Government National Mortgage Association, a government agency that guarantees mortgage-backed securities, MBS, issued by approved lenders, including FHA, VA, and USDA loans, thus providing liquidity to the secondary market. Hard money loans, a type of short-term, high-interest rate loan secured by real estate, often used by borrowers with poor credit or low income to finance real estate investments. Hybrid loans, a type of mortgage loan that combines features of fixed rate and adjustable rate loans, such as a fixed rate for an initial period, followed by an adjustable rate for the remainder of the loan term. Index rate, a benchmark interest rate used to determine the interest rate for an adjustable rate mortgage, ARM, such as the prime rate or LIBOR. Institutional lenders, banks, credit unions, savings and loans, and other financial institutions that originate and service mortgage loans. Insurance, protection against loss or damage, such as private mortgage insurance, PMI, required for borrowers with a down payment less than 20% of the purchase price. Interest-only loans, a type of mortgage loan that requires only interest payments for a certain period, usually 5-10 years, before the borrower must start repaying the principal. Jumbo loans, a type of non-conforming loan that exceeds the maximum loan limit set by Fannie Mae and Freddie Mac, currently $822,375 in most areas. Life insurance company, a financial institution that provides long-term mortgage loans to borrowers, often secured by commercial or multifamily properties. Loan estimate, a disclosure form required by the Truth in Lending Act, TILA, and the Real Estate Settlement Procedures Act, RESPA, that provides borrowers with an estimate of the loan terms, closing costs, and other fees associated with a mortgage loan. Margin, the fixed interest rate added to the index rate to determine the interest rate for an ARM. Monetary policy, the actions taken by the Federal Reserve to influence the supply of money and credit in the economy, such as adjusting the federal funds rate and buying or selling government securities. Mortgage banker, a financial institution that originates and services mortgage loans using its own funds or by selling the loans to investors in the secondary market. Mortgage broker, a licensed professional who connects borrowers with lenders and earns a commission on the loan origination fees. Mortgage companies, financial institutions that originate and service mortgage loans, including mortgage bankers and mortgage brokers. Mortgage loan broker, a licensed professional who acts as an intermediary between borrowers and lenders, usually earning a commission on the loan origination fees. Mortgage loan disclosure statement, a document required by California law that provides borrowers with a detailed description of the loan terms, interest rate, payment schedule, and other fees associated with a mortgage loan. Mortgage warehousing, a process by which mortgage lenders pool their loans together and sell them to investors in the secondary market, providing liquidity to the housing market. Negative amortization, a situation where the borrower's payments are insufficient to cover the interest due on the loan, resulting in the unpaid interest being added to the principal balance and increasing the overall debt. Non-conforming loans, loans that do not conform to the guidelines established by Fannie Mae or Freddie Mac, such as loans that exceed the maximum loan limit. Non-institutional lenders, lenders who are not traditional banks or financial institutions, such as private investors, hard money lenders, or crowdfunding platforms. Open market transactions, the buying and selling of securities by the Federal Reserve in the open market to influence the money supply, interest rates, and overall economic growth. Open-end trust deed, a trust deed that allows for additional loans to be taken out against the property, up to a certain limit. Option ARM, an adjustable rate mortgage where the borrower has the option to make minimum payments that do not cover the interest owed, causing the loan balance to increase. Origination points, fees charged by the lender to cover the costs of originating the loan, typically expressed as a percentage of the loan amount. Packaged loan, a loan that is sold to investors as part of a package or bundle of loans, often referred to as mortgage-backed securities. Participation loan, a loan in which two or more lenders share the risk and potential profits of the loan. Payment shock, a significant increase in mortgage payments that may occur when an adjustable rate mortgage adjusts to a higher interest rate. Pension fund, A fund established by an employer to provide retirement benefits for employees. Points, fees paid by the borrower to the lender at closing, usually expressed as a percentage of the loan amount, in exchange for a lower interest rate on the loan. Portfolio loans, loans that are kept in the lender's portfolio and not sold on the secondary market. These loans often have more flexible terms and may be offered to borrowers who don't meet the requirements of traditional loans. Predatory lending, unscrupulous lending practices that take advantage of borrowers, often through high interest rates, hidden fees, and other deceptive practices. Primary financing, the initial loan used to purchase or refinance a property. Primary mortgage market, the market where loans are originated and funded by lenders, such as banks and credit unions. Private mortgage, a mortgage loan made by an individual or private company, rather than a traditional financial institution. Qualified mortgage, a type of mortgage that meets certain criteria, such as a debt-to-income ratio of no more than 43%, and is considered less risky for lenders. Qualifying borrowers, the process of determining whether a borrower meets the requirements to be approved for a loan. Real estate investment trust, a type of investment that allows investors to pool their money to invest in real estate assets. Release clause, a provision in a mortgage that allows a borrower to release a portion of the collateral from the mortgage lien when certain conditions are met. Renegotiable rate mortgage, a mortgage with an adjustable interest rate that can be renegotiated at certain intervals during the life of the loan. Reserve requirements, the amount of money that banks and other depository institutions must hold in reserve, either in cash or on deposit with the Federal Reserve. Reverse mortgage, a type of mortgage that allows homeowners aged 62 or older to convert their home equity into cash, with repayment deferred until the borrower sells the home, passes away, or no longer lives in the home. SAFE, the Secure and Fair Enforcement for Mortgage Licensing Act, which establishes national standards for mortgage licensing and regulation. Savings associations, financial institutions that specialize in taking deposits and making loans, often with a focus on residential mortgages. Secondary financing, additional financing, beyond the primary loan, that may be used to purchase or refinance a property. Secondary mortgage market, the market where mortgage loans are bought and sold by investors, such as Fannie Mae and Freddie Mac. Seller carryback financing, a type of financing in which the seller of a property provides financing to the buyer, often in the form of a second mortgage. Service Members Civil Relief Act, a federal law that provides certain protections to military service members who are facing financial challenges, including limiting the interest rates that can be charged on their loans. Statement, a document that provides details about a loan, including the interest rate, fees, and other terms and conditions. Subprime lender, a lender that specializes in making loans to borrowers with lower credit scores or other risk factors, often with higher interest rates and fees. Takeout loan, a long-term loan that is used to pay off a short-term loan, often used in real estate development projects. Third-party originator, a person or company that helps to originate loans on behalf of a lender. TILA-RESPA Integrated Disclosure, TRID, rule, a federal rule that requires lenders to provide borrowers with a single, integrated disclosure document that includes information about the loan, including the interest rate, fees, and other terms and conditions. Truth in Lending Act, a federal law that requires lenders to disclose the terms and costs of credit to consumers, including the interest rate, fees, and other charges associated with a loan. Truth in Savings Act, a federal law that requires banks and other depository institutions to disclose the terms and conditions of savings accounts to consumers, including the interest rate, fees, and other charges associated with the account. VA Guaranteed Loan, a type of mortgage loan that is guaranteed by the U.S. Department of Veterans Affairs, VA, and offered to eligible veterans, active duty military personnel, and surviving spouses. These loans often come with favorable terms and require no down payment. Verification of employment, the process of verifying a borrower's employment status and income by contacting the borrower's employer directly. This is a standard part of the mortgage application process and helps lenders ensure that borrowers have the ability to repay the loan. Wraparound trust deed, a type of financing arrangement where a new trust deed is created that wraps around an existing loan. The borrower makes payments on the new trust deed, which includes the balance of the existing loan as well as any new funds borrowed. The existing lender continues to receive payments on the original loan, but the new lender is responsible for making payments to the original lender. This type of financing can be used to avoid having to refinance an existing loan. Unit 13. Escrow and Title Insurance. Abstract, a summary of a property's title history that includes information such as transfers of ownership, legal descriptions, and any encumbrances or liens. Alta policy, an enhanced form of title insurance policy that provides more comprehensive coverage than a standard title insurance policy. Amend the escrow instructions, a change made to the escrow instructions that defines the terms of the sale and the conditions that must be met before the sale can be completed. Beneficiary statement, a statement of the outstanding balance due on a loan that is secured by a deed of trust, usually provided to a buyer during the escrow process. Closing costs, fees and expenses associated with buying or selling a property that must be paid at the time of closing. Closing disclosure, a document provided to the buyer by the lender that outlines all the costs associated with the loan and the transaction, required by the Consumer Financial Protection Bureau. CLTA policy, a standard form of title insurance policy that provides coverage for certain title defects. Credits, amounts of money that are credited to the buyer or seller at closing, typically due to overpayments or other adjustments. Debits, amounts of money that are debited from the buyer or seller at closing, typically due to unpaid fees or other adjustments. Deed of reconveyance, a document that releases a lien on a property once a mortgage has been paid in full. Demand statement, a statement of the outstanding balance due on a loan that is secured by a mortgage, usually provided to a buyer during the escrow process. Escrow, the process by which a neutral third party holds and distributes funds and documents involved in a real estate transaction, ensuring that all conditions are met before the transaction is completed. Escrow agent, a neutral third party who manages the escrow process and ensures that all conditions are met before the transaction is completed. Escrow instructions, a document that defines the terms of the sale and the conditions that must be met before the sale can be completed, which is agreed upon by the buyer, seller, and lender. Escrow officer, an individual who manages the escrow process on behalf of the escrow agent. Extended policy, an enhanced form of title insurance policy that provides more comprehensive coverage than a standard title insurance policy. Good funds, funds that are immediately available for use in a real estate transaction, typically in the form of a wire transfer or cashier's check. Impound account, an account held by the lender that is used to collect and pay property taxes and homeowners insurance premiums. Marketable title, a title that is free of any liens or encumbrances that would make it difficult to sell or transfer the property. Preliminary title report, a report that provides information about a property's title history, including any liens or encumbrances that may affect the title. Proration, the process of dividing certain expenses, such as property taxes or homeowners association fees, between the buyer and seller based on the length of time each will own the property. Rebate law, California law that allows real estate agents to offer rebates to their clients. Recurring costs, ongoing costs associated with owning a property, such as property taxes, homeowners insurance, and maintenance expenses. Special title insurance policies, title insurance policies that provide coverage for specific risks, such as zoning or environmental issues. Standard policy, a standard form of title insurance policy that provides coverage for certain title defects. Title insurance, insurance that protects the buyer and lender from losses related to title defects or disputes. Title plant, a database of title records used by title companies to conduct title searches and issue title insurance policies. Unit 14. Taxation. Acquisition indebtedness, refers to the amount of money borrowed to acquire, build, or substantially improve a qualified residence. Interest on acquisition indebtedness is deductible as an itemized deduction on a taxpayer's federal income tax return. Adjusted basis, the original cost of an asset plus any capital improvements, plus the cost of selling the asset. The adjusted basis is used to determine gain or loss on the sale or disposition of the asset. Ad valorem taxes, a tax based on the assessed value of real property, which is usually levied by a local government. Basis, the cost of a property or asset for tax purposes. The basis is used to calculate the gain or loss on the sale or disposition of the property or asset. Boot refers to property or cash received in an exchange that is not like kind to the property given up. Boot is taxable to the recipient. Capital gain, the profit realized on the sale or exchange of a capital asset, such as real property. Capital gains are taxed at a lower rate than ordinary income. Capital loss, the loss incurred on the sale or exchange of a capital asset, such as real property. Capital losses can offset capital gains and reduce tax liability. Deferred gain, the portion of a gain from the sale of a property that is not taxed until a later date. Depreciable basis, the portion of the basis of a property that can be depreciated for tax purposes. Depreciation, the decrease in value of a property or asset over time, which can be deducted as an expense on a taxpayer's federal income tax return. Entity rule, a rule that requires the transfer of a property to be taxed as a sale if the transfer is to a related entity. Equity indebtedness refers to the portion of a mortgage or loan that is not acquisition indebtedness, but is secured by a qualified residence. Estate tax, a tax on the transfer of property at death, based on the fair market value of the property. Excluded gain, the portion of a gain from the sale of a primary personal residence that is not taxable up to a certain limit. Foreign Investment in Real Property Tax Act, a federal law that imposes taxes on foreign persons who dispose of U.S. real property interests. Home improvements, improvements made to a primary personal residence that increase its value and can be added to the basis of the property for tax purposes. Homeowner's exemption, a tax exemption for a portion of the assessed value of a primary personal residence. Installment sale, a sale in which the buyer makes payments over time, and the seller reports the gain on the sale as the payments are received. Investment property rule, a rule that applies to the exchange of investment properties under Section 1031 of the Internal Revenue Code. Like-kind rule, a rule that allows the exchange of one investment property for another, without recognizing the gain on the sale of the first property. Living trust, a trust created during a person's lifetime to manage and distribute assets to beneficiaries after the person's death. No choice rule, a rule that requires a taxpayer to include all properties exchanged in a tax-deferred exchange, even if the taxpayer do not want to exchange all of the properties. No loss rule, a rule that disallows a loss on the exchange of a property in a tax-deferred exchange. Original basis, the cost of a property or asset when it was first acquired, used to calculate gain or loss on the sale or disposition of the property or asset. Primary personal residence, a property where a taxpayer lives for at least 2 years, and can exclude a portion of the gain on the sale of the property from taxation. Probate, the legal process of administering the estate of a deceased person. The process involves verifying the validity of the deceased's will, paying off any outstanding debts, and distributing the remaining assets to the heirs or beneficiaries. Proposition 13, a California law that limits property tax increases to no more than 2% per year, as long as the property remains under the same ownership. Proposition 58, a California constitutional amendment that allows for the transfer of a parent's primary residence to their child without reassessment of the property's value for property tax purposes. Proposition 60, a California constitutional amendment that allows for the transfer of a property's tax base value from an original property to a replacement property of equal or lesser value for homeowners who are at least 55 years old. Proposition 90, a California law that allows homeowners who are at least 55 years old to transfer the property tax base value from a previous home located in a different county to a new home in their new county of residence. Realized gain, the amount of gain or profit that is actually obtained when an asset is sold or otherwise disposed of. Recognized gain, the portion of a realized gain that is subject to taxation. Reverse exchange, a tax-deferred exchange in which the replacement property is acquired before the relinquished property is sold or transferred. Sale-leaseback, a transaction in which the owner of a property sells the property to a buyer and then leases it back from the buyer. Special assessments, taxes or fees levied on property owners for the purpose of funding specific improvements or services, such as street lighting, sidewalks, or parks. Stepped-up basis, the fair market value of an inherited property at the time of the decedent's death, which is used as the new basis for calculating capital gains taxes. Supplemental tax bill, a bill that is sent to a property owner when the assessed value of the property is increased during the middle of a tax year. Tax-deferred exchange, a transaction in which an investor sells one property and uses the proceeds to purchase another property of equal or greater value, thereby deferring any capital gains taxes that would otherwise be owed. 1031 exchange, a type of tax-deferred exchange that is authorized by Section 1031 of the Internal Revenue Code. Urban Agriculture Incentive Zone Act, a California law that encourages the use of vacant and underutilized urban land for small-scale agriculture by providing property tax incentives to landowners who enter into contracts with urban farmers. Veterans Exemption, a property tax exemption that is available to disabled veterans and their unmarried surviving spouses. Williamson Act, a California law that allows landowners to enter into contracts with local governments to restrict the use of their land to agricultural purposes in exchange for reduced property tax assessments. Unit 15. Property Management and Leasing. Accredited management organization, a professional organization that has met specific standards and requirements for property management companies. Membership in ANAMO requires adherence to a code of ethics, continued education, and a certain level of experience and performance in property management. Accredited resident manager, a property manager who has met certain educational and experience requirements and has received certification through a recognized program. Assignment, the transfer of a person's rights and obligations under a contract or lease to another person. Certified property manager, a professional designation granted by the Institute of Real Estate Management, IRM, to individuals who have completed a rigorous education and experience program and demonstrated expertise in property management. Condominium Association Management, the management of a condominium complex, including the common areas and amenities, by an association made up of the individual unit owners. Costa-Hawkins Rental Housing Act, a California law that regulates rent control in rental housing, limiting the ability of cities to impose or expand rent control measures. Effective rent, the actual amount a tenant pays for rent after factoring in any concessions or discounts provided by the landlord. Estate at sufferance, a tenancy in which a tenant remains in possession of a property after the expiration of a lease, without the landlord's consent. Estate at will, a tenancy in which the tenant has the right to occupy the property at the will of the landlord. Estate for years, a tenancy for a specific, predetermined period of time. Exculpatory clause, a provision in a contract that relieves one party from liability for certain acts or damages. Gross lease, a lease in which the tenant pays a fixed rent and the landlord is responsible for all operating expenses and taxes. Habitability, the condition of a rental property that meets certain basic living standards, including the provision of heat, hot water, and safe and sanitary living conditions. Help Families Save Their Home Act, a federal law that provides assistance to homeowners facing foreclosure and seeks to stabilize the housing market. Holdover clause, a provision in a lease that allows a tenant to remain in a rental property after the expiration of the lease term, subject to certain conditions. Institute of Real Estate Management, a professional organization for property managers that provides education, training, and certification programs. Late charge, a fee assessed by the landlord for late payment of rent. Management agreement, a contract between a property owner and a property manager that outlines the terms of the management arrangement, including fees, responsibilities, and expectations. Net lease, a lease in which the tenant is responsible for paying a portion of the operating expenses in addition to rent. Percentage lease, a lease in which the rent is calculated as a percentage of the tenant's gross sales. Periodic tenancy, a tenancy that continues from period to period, such as month to month, until terminated by either party. Protecting Tenants at Foreclosure Act of 2009, a federal law that provides certain protections to tenants of rental properties that are foreclosed upon. Recapture Clause, a provision in a lease that allows the landlord to recapture a portion of the tenant's profits if certain conditions are met. Rent Schedule, a document that outlines the amount of rent due from a tenant and the due dates. Resident Manager, a property manager who lives on site and is responsible for managing the property. Scheduled Rent, the amount of rent specified in a lease agreement. Security Deposit, a sum of money paid by a tenant to a landlord to cover damages or unpaid rent. Step-up Lease, a lease in which the rent increases by a predetermined amount at specific intervals. Sublease, a lease agreement between a tenant and a subtenant in which the tenant remains responsible for 30-day notice, a written notice given by a landlord to a tenant, indicating that the lease agreement will terminate in 30 days. This notice is commonly used in a month-to-month tenancy or when a lease agreement is approaching the end of its term. 3-day notice, a written notice given by a landlord to a tenant, indicating that the tenant has 3 days to cure a lease violation, such as failure to pay rent, or face eviction proceedings. Trust Ledger, a detailed record of all financial transactions related to a trust account, such as an escrow account used in a real estate transaction. The trust ledger must accurately reflect all funds deposited and disbursed from the account. Unlawful Detainer, a legal action filed by a landlord to regain possession of a rental property from a tenant who has failed to comply with the terms of the lease agreement or has remained on the property beyond the lease term. The action seeks to have the tenant evicted and to recover any unpaid rent or damages.